Have you ever heard the phrase, debt is the root of all evils? Debt can morph into a kind of slavery, and that's true to some extent, as when you're in debt, your life can become a living hell while you try to pay off what you owe. Your creditors don't wait, and the interest keeps piling up. Despite this, the United States has a debt of over $34 trillion at the beginning of this year, already representing 129% of its GDP, making the United States one of the most indebted nations in the world. However, there's good news, as debt isn't always negative. This might sound like a misguided opinion, given that most of the time the debts we acquire are considered bad. You probably have credit card debts, vehicle loans, or even student loans, and might think it'll take years to pay them all off. How can that be a good thing then? To understand how debt can be positive, let's see how wealthy individuals use debt to make even more money. This may sound strange and complicated, as our logic tells us that those with a lot of money shouldn't be in debt, and those in debt are people who don't have money. But capitalism doesn't work like that. In this video, we'll discover how wealthy people use debt to make even more money. So, enjoy the video and let's see 5 ways wealthy people make money through debt. Number 1. Most of commerce is debt-based. A large part of global commerce relies on debt. While this idea might be controversial because starting off in debt to launch a business doesn't seem like the best idea, there are companies, especially traditional ones, where using debt might be the best alternative. Let's say you want to sell electronics, very common products that always have demand. The ideal scenario would be to travel to China and find a factory that produces quality electronics at a reasonable price. You buy a container of these products and ship them to your country to distribute among your customers. Currently, this is mainly done online through sites like AliExpress. The interesting part is that you don't need to pay upfront to get the products. Allow me to explain further. Over the last 5 decades, China has become the world's foremost producer of practically everything needed. In China, there are thousands of factories operating non-stop to produce goods that meet global demand. Most of these factories are willing to sell their products on credit to facilitate sales. These loans aren't granted to just anyone. You need to establish a relationship of trust with them. However, this has been the way business has been done for the last 50 years. Once the customer sells the product in the United States or anywhere else in the world, they can pay the Chinese factory. In summary, it's about borrowing the products, helping the factory sell them, and adding a profit margin to the price. What makes this strategy excellent is that you don't need to use your own money in this transaction. Number 2. Refinancing real estate debts. A mortgage is one of the best forms of debt, as it has many tax advantages. If you don't have a mortgage, you'll have to pay additional taxes. So the wealthy always seek to have multiple mortgages to take advantage of all possible deductions. Every dollar you save in taxes is an extra dollar you earn. So this is another way the rich get richer. To illustrate this, suppose you have $100,000 in savings. While this might seem like a large amount to many people, it's a relatively small amount for the wealthy. You can't buy a house with this amount, and you couldn't get a mortgage for $800,000 because you need to make a down payment of at least 20%. But here's the deal. Imagine you find a property worth $500,000 and it needs major improvements. Go to the bank and get a mortgage, making a 20% down payment, assuming you'll spend 10% of the total cost of the property to refurbish it, roughly $50,000. Then go back to the bank, but this time to refinance the mortgage. When you got your first mortgage, the property value was $500,000 because it was in bad condition and no one was interested. But since you renovated it, families are interested in renting it out, and the market value of this property has increased to $750,000. Just like the first time, you'll get 80% of the mortgage, but 80% of $750,000 is $600,000. $400,000 of this money will go to your first bank that gave you the initial mortgage, and subtracting the other $50,000 you spent on the refurbishment, you'll be left with a profit of $150,000. You earned $150,000 using this debt, and now have a property you've rented out to accumulate capital and generate passive income. Furthermore, you'll avoid paying taxes because you have a mortgage. This is a practice frequently used among real estate investors. Knowing this, do you still think debt is bad? Number 3. Hedge funds. High-risk funds are an investment vehicle created by wealthy individuals to make more money. They operate differently from traditional investments, where one tries to predict which companies will grow and be worth more in the future. These hedge funds use strategies to make money when companies have problems or when their value drops, as it happened with GameStop in 2021. For example, if we think the value of Facebook stocks will decrease because Apple is going to make an announcement that could harm Facebook, we can call our broker and borrow a Facebook stock worth, let's say, $100. Then, we sell that stock in the market for the same value, $100. Now we have that money, but we need to return the stock to the broker later. If the price of Facebook stocks drops to $70 the following week, we can use the $100 we earned from selling the borrowed stock to buy a new Facebook stock for $70 since the price dropped. We make $30. However, this strategy carries risks. What if our prediction is wrong? What if the stock price rises rapidly? Still, we need to return the stock to the broker and pay the corresponding interest. If the stock now costs $200, we'll have to buy it at that price to return it to the broker. When we buy a stock and sell it when its value increases, the maximum risk is losing the money we invested, unless we engage in a short-selling operation where losses can continue to increase if the price keeps rising. Number 4. Forex or foreign exchange market. Forex is a place where people buy and sell foreign currencies. It aids in international trade, making it easier to use currencies like the dollar in countries where it's not normally used. Both individuals and businesses can participate in this market to acquire foreign currencies. The value of currencies in Forex can change for many reasons, such as changes in the economic policies of countries, major world events, fluctuations in the prices of goods we buy and sell, and other factors that affect the economy. For example, if a country's central bank decides to raise interest rates, there may be less of that country's currency available, which can make it worth more compared to other currencies. If you can correctly predict how the currency market will move, you can make quite a bit of money. What makes Forex different from other places where you invest money is that you can use something called leverage. This means that for every dollar you put in, you can trade with much more money, sometimes up to 100 times more. This can help you make more money even if you don't have much to start with, because leverage makes your profits increase faster. Number 5. Credit score. Most commercial enterprises and successful entrepreneurs use it in various ways, particularly if you have a successful business. Virtually all businesses use financing to place orders, so it shouldn't be considered a negative thing. Unlike high-interest debts, which have higher risks, such as credit card debts, you can obtain lower interest rates, minimizing the risk of debt. How is this achieved? By building a reputation as a reliable borrower. There are billions of dollars in banks waiting to be lent, and even if there's no money, banks can create it. Well, folks, that's how capitalism works. If you enjoyed our video today, it's time to leave a like and subscribe to our channel. And remember to always give your best. Do it every day. See you in the next video.